Today we're going to talk about, should I invest in a target date fund? Is this the easy button or the misleading button? If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner with Sickle Hunter Financial Advisors. In theory, target date funds sound really good. I mean, all you have to do is pick one fund, pick the date that you want, and you're all set, right? Well, it doesn't work quite like that, and it's not quite as easy as you think. Here's what I want you to think about. They're one of the easiest investments, especially inside of your 401k, because it's super simple just to pick the date that you want to retire and just go ahead and select that one fund. It also gives you instant access to a diversified portfolio. So you don't have to sit there and fiddle with which fund you're going to choose in each asset class. It just does it for you. And it gets more conservative as you get closer to retirement. But just because it's easy and it sounds good doesn't mean you should choose it. In fact, one of the reasons target date funds evolved was because they wanted to make the 401k or other retirement plans really easy to administer. But that's the key word. They didn't want to have to deal with building portfolios for each individual investor. So that's why they're giving you a bunch of different target date funds, but they also give you the other options to possibly diversify yourself. So the question really is, should you do it yourself? Or should you just pick the target date fund? The thing that jumps right out at me when choosing a target date fund is not everyone has the same goals or aspirations. You might target the same date for retirement, but that doesn't mean you're gonna be the same age as everyone else on that particular year to retire. It's the same as having a 50-year-old and a 60-year-old decide that they're gonna retire in 10 years and they both choose the same fund. Does that mean their risk tolerance is exactly the same and their goals are the same? Probably not. Diversification helps reduce the risk of your overall portfolio by spreading the risk among different asset classes or different positions, which is the right thing to do. But the target date funds put a huge emphasis on diversifying between bonds and equities. And as you get closer to the target date, they increase the amount of bonds. Well, we're in a current low interest rate environment, so as those rates rise, the bond prices will fall. So the bonds inside of a mutual fund don't work the same way as they do when you buy individual bonds. Now, these target date funds are really popular inside of 401ks and other retirement plans because they're easy to administer. But you have to understand, even with target dates out 30 and 40 years from now, so these are the 2045 and 2055 funds, these funds still are holding a high percentage of bonds relative to their time frame. So if you're looking out 30 or 40 years and you're holding bonds, that's a long time not to need that money. When historically equities, stocks, have done a lot better than bonds. So you want to make sure that the risk tolerance inside that portfolio, inside that target date fund, is matched up with your risk tolerance. And I've talked about this before. Your risk tolerance doesn't need to be the same for every type of portfolio. If you're a conservative investor, but you have a retirement plan that you're not going to use for 30 or 40 years, a little education, a little understanding can go a long way to help making sure that you're taking the right amount of risk and not taking too little or too much. Here's an interesting fact to kind of give some perspective on the difference between equities and bonds. The annual return in the S&P 500, and now this is compounded from 1926 until 2015, was exactly 10%. So I don't have the bond index from 1926, but I do have it from 1976 to 2015. And from 1976 to 2015, the bond index returned 7.7. And this is an aggregate bond index. That's 7.7%. That same time frame for the S&P 500 was 11.3. The point is, over a long period of time, the equities are going to outperform, or historically speaking, those equities outperformed the bond indexes. If you're looking at retirement, that's 30 or 40 years out, and that's day one of retirement, that's a long time. You still have another 30 or 40 years in retirement. So do you really need to be that conservative? Should you be holding a target date fund with 10% bonds? It doesn't matter how little it is. Why would you hold it if it's 30 or 40 years out? Just something to think about. And you can also take a look at individual bonds or other fixed income to give you the conservative aspect that you're probably looking for. So by putting your bonds in a different portfolio outside the 401k, then you can look at other alternatives such as buying individual bonds. So it doesn't mean that you can't buy bonds or shouldn't buy bonds. It's just questioning whether or not they should be in your retirement plan. While the target date fund might sound easy, you want your money working as hard as possible. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.